us from the CME Group, Tres Knippa, owner of LotusBrokerage.com. He actively trades index futures, currencies, and some commodities. Also back with us, Rod Smyth, chief investment strategist at Riverfront Investment Group, which manages $2 billion in assets. He's been saying for months that the S&P 500 would trade in a range between 1,000 and 1,200, and that range has held for most of the year. So, Rod, let's kick it off with you. So we're not going anywhere, are we?
I don't think so. Well, I think we are within the range. I think the rally from the July low to the recent high at 1130 has clearly failed, and I think we're going to probably go down during the rest of August and start retesting those lows again. So we actually raised some cash this week, sold some positions. I'm not a long-term bear. I think there's incredible actual long-term value in stocks and risky assets, but I am cautious at the moment, and I don't think you need to be in any hurry because I think the economy really has sort of hit the wall here, and our forecasts for the second half, while not technically a double dip, are weaker than most of the consensus.
Trey, does that make sense? I mean, even if a lot of people we talk to don't expect an actual double dip, they all say we're in a soft patch, there's a slowing, you can feel it. And why be bullish at a time like that?
I guess I'd have to go along with that sentiment, and also just the idea of some uncertainty going on right now. There's so many changes coming out of Washington. We're still kind of choking on what we have to deal with from the big FinReg back on July the 21st, and we had that sharp move up based on all those great earnings that we had off the lows in the Dow. But now the Fed on Tuesday essentially downgraded our economy, and I don't know anybody that's particularly bullish the economy. There's also a kind of an odd chicken or the egg kind of scenario right now. Do we have to improve corporate earnings before job growth picks up? Granted, we're coming off of some good, solid corporate earnings on last earnings season, but I think a lot of people may be a little bit skeptical that that's sustainable in the longer term.
Hey, Trey, let me ask you. I've got a viewer writing in. It says, do you guys think that this late-day bond rally stock sell-off is just people going into the weekend not wanting to be short bonds? What do you think's going on here?
Well, as far as bonds, sorry, go ahead.
I'll try and take that one, which is, I think if you know that the Treasury is out there and is going to be prepared to be a buyer as a trader, you're reluctant. I think the issue, though, if you're an investor, not a trader, and you really do have a 3 to 5 year time frame, then there's no doubt in my mind you don't want to own bonds and you do want to own stocks. Within the bond world, you can own credit and you can own high-yield bonds. But
right.
If the Fed is successful, ultimately yields are going to be higher.
Trey, do we blame the Fed on this week's decline? We're down almost 4% on the S&P. So is it all the Fed's fault in your view?
I wouldn't, blaming the Fed, I don't know if that's the way I would put it. I would just say that because if you remember correctly, we did rally off of the Fed number. So like I said about when we were talking about earnings before, but that idea of a downgrading the economy and the Fed not being super enthusiastic about what the economy has in store for us. Also, there's something I want to point out. Now, granted, this is just one of the things that I look at as an individual trader on the floor. But when we rallied on earlier in the week on the Fed announcement, even though you rallied, the NASDAQ was not leading the way. The NASDAQ has really been a leader. Today's a perfect example of that. We came off of our lows overnight. We were lower in the overnight session. We came back, but even as you came back, the NASDAQ was still losing ground to the S&P futures. In my mind, that's a rally that you sell into when you don't have confirmation of that NASDAQ going with it, and that strategy has served me well over, I'd say, the last 2 or 3 months.
Hey, Trey, it's Dominic here. One of the things that a lot of us cued in on today was the idea that the 10-year Treasury yield kept on dropping despite the fact that the market was trying to make runs up or trying to get flat. Does that concern you at all, that the fact that 10 years are on this just downtrend in terms of yield?
Who's going to sell them? I mean, right now, nobody wants to take home a short position. Every person calls me from my brokerage customers. They all want to try to get shorted only because yields are low. They don't have a real story of why yields should kick up. Or are we in a rising interest rate market? It doesn't feel like it to me. And as long as that hangs around, then trying to be short bonds or bond futures, I just don't see the way to go.
What do you think about that, Rod? I mean, do we see?
Yeah, Dominic. I was going to say, Dominic, it's not just today. We've had 3 signals that we've been watching for an all clear to try to get us out of our short-term risk management mode. One was credit spreads. They've behaved relatively well. The second one was the stock market making a convincing break above the 200-day moving average. And, of course, it just failed again this week. But the third one, which has been resolute now for months, was that bond yields had to be rising. Because if you have a 2.5%, 2.75% 10-year bond yield, what that is saying is that nominal GDP growth, that's GDP growth including any inflation, won't be any more than an average of 2.5%, 2.75% for the next 10 years. That is depressing. I don't think it's going to be that bad, but that's what that market is telling you. And if you are a risk manager, you've got to be very careful to be going out taking risk when the market is so strongly sending that message.
Hey, Rod, it's Julie. But what about the other choices that are out there? I mean, we were just talking about how, nobody wants to short treasuries, but we learned that in July, Bill Gross was reducing his holdings of government debt here in the U.S. and looking to emerging markets debt instead. So, I mean, sometimes I feel as though the discussion is that it's government debt or nothing. But, of course, there's a whole world out there.
Yeah, absolutely. And I, for one, would love to short U.S. government debt as long as I've got enough time to be right. Because if you consider the spectacular irony, the reason that the Fed is buying this stuff is because that ultimately their goal is to get growth going, and if they need growth. We, the U.S., needs growth of more than 2.5% if we're ever going to pay off our debt. So ultimately, my judgment, yields are going to be higher, either for good reasons or for bad reasons. But you have to try and get your timing right. In terms of opportunity, again, I'd say the same thing. I can own stocks that are paying me a dividend yield more than the Treasury yield. And if I'm just patient about watching the price fluctuation, I think I'm going to do much better over a longer period of time. So we have our core investments are in high-quality global franchise businesses. And, yeah, let's face it, I'm happy to invest in the developing world. There we're not in sluggish box patterns. We're in secular bull markets. But we do have to have a risk management strategy. And right now, my risk management strategy is just to be a little cautious. I think I'll get better entry points.
Let me ask you the same question I asked Bob Dalla a little bit earlier, Rod, and that is, do you get neutral or even a little bit defensive heading into November? I mean, is there so much uncertainty that you want to wait it out, or do you try and get out ahead of what happens in November?
Actually, I think my favorite site for November is to watch the in-trade site, where people are actually betting real money on the outcome of the elections, and I think you want to get in ahead of that. I think there'll be some hope. Unfortunately, I see a big contrast between the U.S. and the United Kingdom. What you're likely to end up with in the U.S. is gridlock. And gridlock isn't really what we need right now. For the market, it'll be better than the current administration, I suspect. But what you really need is a consensus that's starting to produce longer-term solutions. That's what the UK has right now. And both the UK and Germany are markets that I'm actually looking for an opportunity to buy.
Hey, Trey, in terms of opportunities to buy, do you think it could come next week, or should we just all pack it in and just wait for September? Because volume obviously very low today. Anything on the calendar next week that you think could significantly impact the markets?
I think I'd probably be watching closer levels that you get to, more so than a particular event or some particular set of news, that sort of thing. I'm going to be watching some levels, and guess what? We are down kind of towards our lows of the week here, so I'm not going to be eager. I'm probably going to go home a little bit short S&P futures this evening and see. And what I've noticed is look how weak the euro has been after the Fed announcement. The euro tried to come back. It rallied. The futures rallied back to about unchanged. Then the next day just completely fell off the map, and the euro seeing significant weakness again today. So I'm going to ride that weakness into next week and see what can happen and stay short for a minute.
Hey, Trey, it's Dominic here. Speaking of Europe, just the idea here that the pigs are back in focus, right? I mean, we have problems in Ireland, an Italian bond auction that didn't go off as well as we thought it would. Is this pretty much bringing the thing right back to the macroeconomic global concern rather than just the U.S.?
Why shouldn't it? I mean, I'm from Ireland, and when you have to take another, what was it, 12 billion and give it to Anglo-Irish Bank, You know, you're talking about a country that probably only has 2.5 million taxpayers. You just wrote a check for each one of them for about $2,000 today. I mean, this is not a good situation. I don't think the ECB stress tests were anything like the Fed stress test. If you've got a bank that's surprising the market in its need for capital, 2 weeks or something after the stress tests, it's no wonder to me that the euro has rolled over.
All right, Tres Knippa of LotusBrokerage.com, Rod Smith over at Riverfront Investment Group. Guys, thanks so much. Have a great week.